So this week we're talking about cash to accrual conversions. Now, this might sound like we're converting from a cash basis system to an accrual based system, but that's not really what we're doing. All we're doing is we're working entirely within an accrual system. However, what we're doing is using cash information to determine what accrual adjustments may have been made, or we're doing it the opposite way. We're using accrual information to determine what the cash flows may have been. Now, this is going to hopefully highlight the system that accrual encompasses both cash and accrual conventions, that it's not just one or the other, that accrual includes both. So I wanted to, again, sort of revisit this Venn diagram that I drew, because I've gotten a few questions about, well, why did you debit cash? We're in an accrual system. You said that it doesn't involve cash, and that's totally not what I said. Adjusting entries don't involve cash. So adjusting entries are the big difference between a cash and an accrual system. They're not the only difference, but they're the big difference. So accrual systems, right, the reason why this circle's on the outside is that it not only has additional information not in a cash system, but it also incorporates that cash system. So accrual does everything that cash does, and it expands by allowing us to record revenues and expenses without having to exchange cash. So, this is a big concept thing. And if you're not getting that, you really need to revisit it, go back to the videos that I've been putting up, go back to your notes, talk to me about it, because if you don't get this, the rest of the semester is going to seem like this kind of random, illogical pattern of journal entries. You're not, I think that the misunderstanding of how an accrual system works is the reason why people don't know what accounts to debit and credit. They don't know when to recognize revenues and expenses. They start to memorize things, and it's just not going to be possible. Like, you can get through intro doing that. You're not going to get through intermediate doing that. So you got to change your approach now. You can't just brush these off like, oh, concepts, who cares about concepts? I just want to do. Again, not going to happen. And for good reason. Like, just doing things without understanding why you're doing them is a recipe for disaster and legal issues. So big concepts, accrual-based system, and remember that the accrual-based system is made possible by the revenue recognition principle and the matching principle. If you don't know what the criteria to recognize revenue is, what the criteria for recognizing an expense is, again, you're going to find the rest of the course really tough to handle. So get those down, and don't just ignore the concepts because they sound kind of like the less technical parts. Oh, this isn't stuff you test. These are great questions that many students need to know the answers to in order to do better and to successfully complete the course. So when we're doing these cash to accrual conversions, like I said, that name, that's what they've always been called. As long as I, sit back when I was a student and taking intro and intermediate. But they're not really converting, because we're not converting from a total cash-based system to a total accrual-based system. Like I said, we're using information that is either accrual-based or cash-based to determine the other basis effects. So we get some accrual information, and we have to figure out, well, what were the cash flows during this period? Or we get some cash information, and then we have to figure out, well, what were the accruals, the recognition of expenses and revenues without cash that happened during this period. And we're going to do that by using beginning and end balances of permanent, which another name for permanent is real accounts. So we're going to approach it from that, and this is going to be great help in terms of solidifying those adjusting entries that you've been working on, figuring out how cash and accrual come together in an accrual system, all under the same, overarching system, and also using T accounts and journal entries and how those two interact. So I'm going to look at the third problem set, and that's in your content 2, module 2 area. And I'm going to look at the second big problem in there. It has 5 different mini problems that are all similar. And I'm going to work number 1 and number 3 and walk you through it. And then you really need to work number 2, number 4, and number 5 on your own. Make sure you've got this down. And if you don't, please ask some questions on in my class or email, or come to a Zoom session to make sure that or make a Zoom session with me so that we can figure it out together. So let's look at number 1. The very first question under that second piece, it starts with Norse Company, and Norse Incorporated paid $33,000 into its prepaid insurance contracts for the year 2016, and it received $73,000 of cash in advance for services. So we paid some prepaid insurance, we paid cash for that prepaid insurance, and then we received some cash for something we're going to do later. So the first step is to make those journal entries for that show the flows of cash. And again, we're making these journal entries under an accrual system. It's just because it's an accrual system because right? If this were a cash-based system, we wouldn't be recording prepaid insurance with an outflow of cash. This would be insurance expense of $33,000. So this is an accrual system. This is not, neither of these are adjusting entries. These are both entries that would be recorded during step 1 of the accounting cycle. We received some cash or we paid some cash. So what did we get for the cash we paid? Well, we got some prepaid insurance, right? And what do we owe for the cash we received? We owe some services in the future. So that's a deferred or unearned revenue. When you make these journal entries, of course, I don't even ask for these particular journal entries. But, this is kind of a way to set up, to teach you how information enters into the T accounts that I'm going to create below. And also, it's good to practice with the effects to assets and liabilities and net income so that you make sure that these journal entries mean more to you than just simply 2 accounts, that you just know the names of, but don't really know what effects they have. So then we're going to use the account information that's provided, the prepaid insurance account, the unearned revenue account at year-end 20x5 and year-end 20x6 in order to build a T account. So we build that T account. This has some steps to it. So the first step is we're going to draw in these balances. So that's just using the information from the problem. It started at a balance at year-end 20x5 of 17, ended 20x6 at 25,000. And same thing for deferred revenue. And I apologize that these are already worked out. When I made this video, for some reason it corrupted, and I have to redo it. And I admit to a bit of not wanting to rewrite everything I wrote the first time. But this is our first step. We establish these balances. Step number 2 is then incorporating any information we got from the problem into the T account. So this is where we take what we did in the journal entry and post it into the ledger. We take the $33,000, right? We debited prepaid insurance. That gets debited into our ledger T account. We look at the deferred revenue, credit of $73,000. That gets credited into this T account to show that posting into the ledger. Now, the third step is solving for the unknown. If you look at the information you have without that $25,000 being present, right, so just sort of block that out, then you notice that, well, I have $17,000, I have $33,000. That would add up to an overall debit balance of $50,000, but that can't be because my ending balance in this account was $25,000. So I must have had an offsetting entry that made it $25,000 rather than $50,000. Well, that means I would have to have credited my prepaid insurance by $25,000. Same thing is true over here with deferred revenue, right? Blocking this guy out on the debit side, I have 38,000 and 73,000. That would give me an overall credit balance of $111,000. But I only have a credit balance of 23, so I must have had an offsetting debit entry. So 111,000, to bring that down to 23, we would need $88,000 of a debit. The final piece then is to understand that these two items were entered by adjusting entries. Right? And so I give those journal entries. Again, I didn't ask for those journal entries, but I only asked for the expense and the revenue. But these aren't expense and revenue accounts. These two entries right here, the 25 and the 88, these entries into our ledger were part of a journal entry that recognized the expense and the revenue. And so how do we know that? Well, think about your common adjusting entries. When we credit prepaid insurance, what is that from? That's from recognizing insurance expense. $25,000 of insurance expense, $25,000 credit to prepaid insurance brings that down to the correct amount. Over here, deferred revenue. It was $111,000. We debited it by $88,000. Well, how do we get rid of the obligation of deferred revenue? We perform the service or provide the good, so we reduce our obligation. And because we've now performed our obligation, our part of the contract in order to provide the service for the cash we received earlier, we can now credit sales revenue. So the answers are actually $25,000 of insurance expense and $88,000 of sales revenue, right? These are both adjusting entries, and both should be familiar if you've been working through the second problem set, the accounting cycle problem set. Let's look at number 3, because number 3, this was all about getting cash information and converting it into accrual. But number 3 has a mixed bag. In one case, it gives you some accrual information that tells you how much expense was recognized, and then asks you to find the cash that was paid. And the other one gives you the same approach, where it gives you some cash information and asks for the accrual. So for number 3 here, I'm looking at Absidarian. They sublease rental units to commercial businesses. The amount, so subleasing, right, that means that they are renting it from somebody or leasing it from someone, and then turn around and rent it to somebody else, right? So it's sort of being a middleman. So they have a business where they're paying somebody rent, but then someone else is paying them rent, right? They're just managing the property, so to speak. So the amount of rent expense that they recorded on what they're paying was $70,000, and they received cash from its commercial business customers of $200,000. So they had rent expense that they paid to the person they're renting from, and then they turn around and rent it to folks. Those folks paid them $200,000. So they have, as you see on the problem, prepaid rent on leases. That's what they're paying their landlord. And then they also have unearned rent revenue from customers. That's the people who are paying them. Right? So recording that would be a debit to rent expense for $70,000. That's recognized during the period. And again, we know that when we recognize rent expense, we have this prepaid rent account where rent expense depletes the prepaid rent. We received $200,000 from our customers, so we got cash, but we now have an obligation to provide rent. So that is going to be debit cash and credit unearned rent revenue for $200,000. So now that we have those two pieces, we can go ahead and again lay out the account work, prepaid rent and unearned rent revenue. We follow these real accounts. Remember, step 1 is to use the balance information to appropriately record the beginning and ending balances. Step 2 is to incorporate this information from the problem and those journal entries that I recorded above, bringing the $200,000 down as a credit here and then earned rent revenue, bringing the $70,000 down as a credit here to prepaid rent on leases. And then step 3 is solving for these missing amounts. And you really need to get used to reconciling T accounts this way. And it is much easier. This is why T accounts start becoming much more useful. It's much easier to do it this way than with an equation, right? Equations get really tough when we start having multiple things happening, especially when you have a debit side and a credit side, because one's not necessarily negative or positive. You get into issues, and I'm sure we'll talk about those more as we get further in. But T accounts are the way to go, period. Remember, what we're looking at is 2,000. We end up with 3,000, and we just knew that there was a $70,000 credit. Well, then what must have happened to take me from 2 to 3? Again, so the way that I usually solve for this easily is to say, all right, well, I had an overall increase of $1,000, right? An overall debit increase of $1,000. If I had a $70,000 credit, then that must mean I must have had $1,000 more of debits to get that $1,000 increase. So it must be 71. Over here, you approach it a little differently. You have 7,000 and 200,000, right? Well, 207,000 is not 10,000. You could say, well, what do I have to reduce 207,000 by to get to 10,000? And the answer would be 197,000. Or again, you could say, all right, I went from 7,000 to 10,000. That's a $3,000 increase. Right here, I have a $200,000 increase. So I need to get rid of all but $3,000 of this increase. That would be 197,000. So the math isn't that hard. It's understanding where all this stuff fits in that's the more difficult part, quite honestly. Now, looking at how we get these items in there, because they don't just magically appear in these T accounts, they had to be journalized. So a debit to prepaid rent, right? How do we increase prepaid rent? We increase it by paying it. So the debit to prepaid rent would be a debit to prepaid rent of 71,000. We got that. We know it needs to be in there with a debit there. The only way to get more prepaid rent is to pay money to somebody so that you establish a longer rent contract. Well, then that's a credit to cash. Over here, we have $197,000 of a debit. Well, when we earn unearned rent revenue, we know now, after enough times, that as we earn unearned rent revenue, we can now recognize sales revenue because we've done the work. We can apply the revenue recognition principle and record a credit to sales revenue for $197,000. So that's the first two. You should absolutely do number 2, number 4, and number 5 on your own. Number 5 in particular, it will really kind of test your ability to understand the basic journal entries, adjusting entries, and filling out this account information. And if you have any issues with these, of course, always email me, set up a Zoom session, or let's talk about it in person in class. Thank you for watching. And if you're just not getting this, then really I feel like Module 2, Module 1, you need to strengthen that. You need to have these big concepts down. You need to know adjusting entries. You need to know the accounting cycle. You need to understand that stuff really well in order to start applying it in these different ways in order to figure out the additional information.